The top business stories live from the Sky News City studio. No scope for unfunded tax cuts or spending increases. I've been speaking to the Institute for Fiscal Studies about its green budget. Wages growth slows for the first time since January. Plus, the aircraft engine maker Rolls-Royce confirms plans to cut up to 2,500 jobs worldwide. Good morning, this is Business Live with me, Ian King. It's now just over a month until the autumn statement, with the Chancellor Jeremy Hunt under growing pressure from Conservative MPs to cut taxes ahead of the general election. But in its widely followed green budget analysis published today, the influential Institute for Fiscal Studies suggests Mr Hunt has no scope for unfunded tax cuts or spending increases either this year or next. I've been speaking with Paul Johnson, Director of the IFS, and began by asking him how the Institute had reached that conclusion.
We're in a very strange situation in which we've got taxes actually rising to their highest level essentially ever. So you'd think with taxes at that very high level, there would be scope for some real serious fiscal room for manoeuvre, but there isn't. And there isn't for a couple of reasons. One is that economic growth is so poor. But a really key issue here is that we're spending so much on debt interest. Obviously, we accumulated lots of debt over COVID and indeed going back to the financial crisis. A lot of that's held by the Bank of England, a lot of that's index linked. So the impact of higher interest rates comes through very quickly in terms of higher interest payments. Then you add that to what's actually been quite significant spending increases over this Parliament and pressures on things like pensions going forward, and you end up with this horrible place which we're in, where we've got very high levels of tax, and yet the national debt is stuck. It's stuck at getting on for 100% of national income, and there's no indication that it's even beginning to come down.
Now, you have public sector borrowing at 5.1% of national income this year, falling to 3.2% in 2024-25. That doesn't seem particularly high compared with some comparable economies such as France.
Now, our borrowing, in a sense, isn't terribly high. I mean, by our historic standards at the moment, it's pretty high. But it's coming down quite fast. And again, one of these extraordinary sort of fiscal situations we're in. So you look 3 or 4 years ahead on current forecasts, we're actually running a primary surplus. In other words, we're bringing in more revenue than we're spending on everything other than debt interest. And actually, the overall deficit in a few years' time really looks quite small. But even with that relatively small deficit, with low levels of growth and high levels of debt to start with, we've still got debt absolutely firmly stuck, anchored at getting over 100% of national income, which is why I think we describe this as this horrible fiscal bind that the Chancellor's in, even though on some measures it looks like we're running a pretty fiscally conservative kind of economic strategy. That's still not enough to achieve what the Chancellor has said he wants to achieve, and indeed what the Shadow Chancellor has said she wants to achieve, which is to get debt falling over the medium term.
Now, you've had a good look at one or two big policy announcements, or potential ones, including the NHS workforce plan. You seem quite pessimistic that that is going to be able to meet demand for NHS services unless we get these big productivity improvements.
Well, the NHS workforce plan, I mean, it's 75 years late, but thankfully we've got an NHS workforce plan at last. And boy, do we need it, as we've seen with some of the problems we've had with the NHS over the last few years. And I don't think people have still quite got their heads around what a big thing this plan is. I mean, if it comes to fruition, 1 in 11 adults, or working age adults in the UK, will be working in the NHS in 12 years' time. And the cost of this plan is about 2% of national income. That's a colossal amount. I mean, that is equivalent. I mean, that would require either very big spending cuts elsewhere in government or another 2% of national income increase in tax, £50 billion or so. Now, I think what I'm sceptical about is whether this plan is actually something that will finally be delivered, partly because of its cost and partly because of the genuine difficulties in delivering. But I think it's just one example, one illustration of how much more we're likely to end up spending on health over the next decades, which of course is actually just a continuation of a trend that we've seen over a very long time. And it's one of the another, I think, of the reasons why whatever chancellors might say they're able to do in the short run, those spending pressures into the medium run are just huge.
You've also had a look at options for reform of inheritance tax. You recommend abolishing the nil-rate residence band and also abolishing agricultural relief. Those strike me as being in the sort of too difficult box for politicians.
I think some of those might be. I mean, there's lots of things that you could do with inheritance tax, which I hope wouldn't be in the too difficult box. So, for example, the way that we treat shares on the AIM market, where essentially they're entirely free of inheritance tax, the way in which we treat pension pots, astonishingly, entirely free of inheritance tax. I mean, we are much more generous than most countries in the way that we treat closely held businesses and indeed agricultural land. That's one of the reasons why we've got a very, very high rate of tax, 40%, but not particularly high revenues. And it also, because we have all of these kind of rather obvious loopholes, it's also why the rate of inheritance tax on a £2 million inheritance is about double the rate of inheritance tax on a £10 million inheritance, because it's so easy, if you've got serious amounts of money, to get around it. So what we would like to see is a reform which gets rid of some of these loopholes and then arguably use some of that money to really significantly reduce that headline rate.
If an incoming Labour government wanted to increase public spending significantly, are there any obvious tax levers that it could pull?
Well, part of the problem it faces is that the current government has pulled the biggest and easiest of them all, in that it's raising a quite staggering £50 billion a year just by keeping income tax thresholds and allowances frozen for 6 years. That, if you think of that as a single tax rise, it's arguably the single biggest tax rise in history. I mean, maybe it's unfair to think of it as a single tax rise. So in a way, the easiest way to really big money has already been snaffled by the current government. Beyond that, if you're looking at significant money, it's as ever quite hard. We've already had, as you know, another big increase in corporation tax. So the biggest taxes, VAT, national insurance, income tax, you can always raise rates and so on there, but that's obviously politically unpopular. And the sorts of things that Labour are talking about, VAT on private schools, changing non-dom status and so on, they don't raise very much. I mean, we're talking 2 or 3 billion a year there out of £1 trillion budget. That's really not very significant. So again, it's a real challenge for Labour, particularly, and I suppose one of the things they're going to need to be careful to do, or not to do as we go into the election, is to rule out all of their room for manoeuvre, which we've seen various parties do in the run-up to previous elections.
Closing thought, Paul. If there's no scope for tax cuts or spending increases this year, why are we bothering with two fiscal events? We've got an autumn statement and then we'll have a spring budget.
That's a very good question. I mean, we'll have to wait and see. I mean, look, one of the things that we could easily see, particularly I think in the spring budget rather than the autumn statement, are some headline changes which look like tax increase cuts, which aren't actually terribly big. So the Chancellor could always find a few billion down the back of the sofa, and I'd be very surprised if he doesn't find a few billion, in particular in the spring budget. But that's not going to change the overall story, which is that this will have been probably the biggest tax increase in Parliament in history. And it's quite hard to see. I mean, the scale of tax cuts that will be required to undo that will be almost certainly beyond what is possible. But you know, your broad question, why do we have two fiscal events a year? Well, I wish to goodness we didn't have two fiscal events a year. I mean, most countries do without any fiscal events. They just treat fiscal policy just like they treat all other policy. And I think it's actually really rather damaging that we continue to have chancellors standing up and often just doing far too much with far too little consultation in these fiscal events.
Some wise words as ever there from Paul Johnson. Just got a bit of breaking news to bring you. And a 77-year-old woman has died after a bus crashed into a shop in Piccadilly Gardens in Manchester yesterday lunchtime. Greater Manchester Police said Almina Amica from South Manchester was taken to hospital with serious injuries but later died. 11 other people were either treated at the scene or in hospital for minor injuries. A 64-year-old man has been bailed on suspicion of causing death by dangerous driving after having been arrested at the scene. Our wages growth slowed in August for the first time since January this year, but continued to grow at one of the fastest paces on record. Well, the Office for National Statistics said that excluding bonuses, average weekly earnings during the 3 months to the end of August were up 7.8% on the same period last year. That was slightly down on the 7.9% growth seen during the 3 months to July. It means earnings growth has now outstripped the headline rate of inflation for the last 3 months. The ONS also reported that in September there were 11,000 fewer people in employment than in August, but it said that year on year employment grew by 369,000. Some other business news stories for you now. And Rolls-Royce has announced plans to cut between 2,000 and 2,500 jobs worldwide. Confirming a story broken last night by Sky's Mark Kleinman, the aircraft engine maker said the reductions, which amount to 6% of its global workforce, were aimed at simplifying its operations and making it easier to serve its customers. The majority of job cuts are expected to be in back-office functions such as finance, legal and human resources. The move will see Rolls merge its engineering, technology and safety divisions, as well as the creation of a new business-wide procurement and supply management operation. Rolls-Royce shares are currently ahead by some 2%. St James's Place is to simplify its charges and fees to comply with new regulations aimed at cracking down on high fees. The UK's biggest wealth manager, which has more than 900,000 clients, said it would result in a reduced overall ongoing charges for existing client investments across its core products. Among the biggest changes will be an end to early withdrawal charges for most new investment bonds and pensions. Well, shares of SJP, which fell by a fifth on Friday after it emerged the regulator was putting pressure on it to cut fees, have risen by 2.25% this morning. Bellway warned today that it will build significantly fewer homes this financial year. The UK's sixth largest house builder by stock market value said that in the year to the end of July, it had completed a near record 10,945 homes. But it said that was likely to fall to 7,500 this year due to its reduced order book and lower reservation rates. It also expects average selling prices to be down by just under 5%. Full-year pre-tax profits on an underlying basis fell by 18% to £532.6 million. Shares have fallen by 1%. Well, last night's gains on Wall Street were followed by advances overnight for equity markets in the Asia-Pacific region. The Nikkei in Tokyo recouped nearly half of Monday's losses. In Europe, stocks are also in positive territory this morning. Well, they were. All the continental European indices now in negative territory. That's a very recent development. Talking points today include Ericsson, the Swedish telecoms equipment maker, has fallen by more than 8% to a 6-year low following a downbeat trading update. Its Finnish peer Nokia is off some 4% in sympathy. As for the FTSE 100, well, that is in positive territory, up a third of 1%, led by healthcare and utility stocks. In percentage terms, United Utilities is the leading gainer. That's on a push from one of the brokers, Rolls-Royce. I mentioned them a little earlier. Given back some of their earlier gains, but still up more than half of 1%. In the same sector, Melrose is ahead by 1.5% after investor presentations well received. Now actually up only just over half of 1%. Outside the FTSE, Jupiter Fund Management off 11.25%. That's after a bigger than expected drop in funds under management during the latest quarter. But Money Supermarket has rallied by nearly 8% after a trading update proved no worse than expected. On the foreign exchange markets, the pound has been drifting a little on the back of the wages data today, currently off 0.5% against the dollar and 0.2% against the euro. As for the oil price, well, that sold off yesterday, but this morning has traded in a very narrow band. Barrel of Brent crude will currently set you back $89.86 a barrel. That's up 0.25%. Well, joining me this morning is the senior equity analyst at Investec Wealth, Simon Lapthorne. Simon, welcome to you. What do you make of these Rolls-Royce job cuts? They were anticipated.
Yeah, I don't think it comes as a great surprise. The context for this is the new chief executive joined in January this year, and he was talking about a multi-year programme to improve Rolls-Royce's position. He said it's just not very competitive against other companies in its sector. The technology is great, but the organisational structure not so great, and he wants to improve that and bring that into line with the quality of the engineering they deliver and be able to maximise their opportunities. And he said this is a multi-year programme. So I don't think an event like this is a terrible surprise that they should be making restructuring. I mean, it's relatively modest. It's about 5-6% of the workforce, as you said, although obviously job losses for anybody at the individual level are a very serious business. And if we look at it in the context, I think you said the shares were up initially, I think about 2%, now only 0.5%. That's in the context of a share price that over the last 12 months is up more than threefold and included two really big up days when it has twice upgraded the outlook for this year, albeit from a very, very low base. I think it was a multi-year low apart from the immediate aftermath of the pandemic. So I don't think it's a great surprise that they've announced this, and I would imagine there will be more to come as he pursues the reinstatement of the investment grade rating and ultimately the dividend, which obviously is important to equity investors.
Absolutely. Now, what about the job figures today? Were there many takeaways in it for you?
No, I don't think so. The job market still seems to be reasonably robust. I think as far as the UK economy is concerned, the wage data is probably of more interest. It was in line with expectations, but it highlights the conundrum, if you like, that wage growth is now outstripping inflation, which eases the cost of living situation for many people. So that's supportive of consumers in the economy. But the flip side of that is the likelihood that interest rates remain higher for longer. And that could have, the opposite effect on people's spending power. And of course, in this country, we tend to have relatively short 2, 3 to 5 year fixed rate mortgages. And the number of people that have rolled off and had to refinance is nowhere near fully matured. So there's still, the longer rates stay high, the more people are going to have to be refinancing at higher rates. So I think it's a pretty delicate balance for the UK economy at the moment.
Yeah, and for the Monetary Policy Committee.
Indeed.
Now, looking ahead, we've got results from Whitbread tomorrow. What are you looking out for there?
Yeah, so Whitbread is, which we've often talked to clients and to the media about the sort of the disconnect between the UK economy and the UK stock market. Something like 80% of earnings come from overseas. Whitbread is one of those companies that is almost exclusively focused on the UK, has a small business in Germany. And so it provides an interesting snapshot of the state of the UK economy. So we're expecting continued strong growth in the accommodation business. We think double-digit growth there. That's a slower rate than in the previous quarter. But I think what will be most interesting is what they say about the current state of trading, whether they're seeing any signs of tightness. And they're coming against tougher comps, year-on-year comps, as the year progresses. So I think it'll be a solid performance, but I think the key will be what are they saying about now and the outlook for the next quarter, probably.
Should be very instructive. Simon, got to leave it there. Appreciate you joining me as ever. Thank you.
Pleasure, thank you.
Still to come here on Business Live. The rise of fintech in Africa. I'll be hearing from the chief executive of one of its largest startups next. Flutterwave. Don't go away.
There's always more to the news than a headline. We want to discover, to delve a little deeper, to find out what's really going on. Explanation, analysis, the people at the heart of every story. I'm Neil Patterson, and this is the Sky News Daily Podcast. Alex Crawford joining us now from Ukraine.
Their personal possessions are all scattered around the place.
Our economics and data editor, Ed Conway, try and make sense of the big numbers for us.
Things can change incredibly quickly, and that's what they have done.
So, by the end, we'll hopefully all understand what's going on in the world just that little better. Available wherever you get your podcasts.
It's like Emirates. It's like better. Fly Emirates. Fly better. Thank you.
Welcome back. Just want to bring you a bit of breaking news that's just reached us. A statement from the Competition and Markets Authority in which they've said they're going to be investigating Worcester Bosch. And the investigation is going to focus on whether marketing claims for the firm's so-called hydrogen blend ready home boilers, which cost between £1,500 and £3,200 each, may mislead consumers into thinking they are more environmentally friendly than they actually are. Interesting story. That will try and get a bit of a response out of the company and bring that to you when we can. Now, fintech is disrupting the way money moves among individuals and businesses, and nowhere can that be seen more than in Africa, where fintech transaction volumes have been growing most rapidly. To that end, Microsoft has recently announced a live 5-year partnership with Flutterwave, Africa's leading payments technology company, with the aim of making it easier for small and medium-sized businesses on the continent to access financial services. Well, joining me now is GB Agbula. He's Chief Executive and founder of Flutterwave. GB, welcome to you. What does this partnership bring you?
Thank you so much. So this partnership helps Flutterwave to continue to be a leader in processing of payments across Africa. Today we help SMBs, enterprises, and companies like Uber, Netflix to pay across the continent. With this partnership right now, we're able to scale this forward and be a bit more emphatic in our growth and scale for SMBs in Africa.
Now, you've processed 400 million transactions since you were founded in 2016. Where are you seeing growth most rapidly right now?
So growth is happening across so many segments. Enterprise, for example, if you get into on a flight from Lagos to Johannesburg through Hairpiece, it's also being that putting that payment for you, right? If you send money from the UK to Nigeria, for example, it's Flutterwave doing that payment. So our send app is growing massively, over 400% growth year on year on our send app product. We're growing our point of sale machines as well. If you get to Lagos today, you can swipe your American Express card via Flutterwave, and it works really well in Africa. And we are basically building the infrastructure of payment across the continents.
I'm asking you to generalise terribly here, but what does a typical transaction look like?
So it's just very simple. You get to an Uber in Lagos, Nigeria, or in Cairo in Egypt, right? You swipe your card on an Uber, it just works, right? You are paying for your subscription on Netflix, right? It just works. You are sending money from the UK, whole back home into Africa, or you're paying a school fees from Africa to the UK or to the US. It just was. So what we do really is we're the infrastructure, where every payment to work seamlessly for the end user in Africa or the SMBs or the enterprise, wherever they are in the world.
And what's the average transaction size?
So it varies per segment. For example, if you look at the Uber, for example, it's low value, high volume. You look at, airline tickets, those are high value tickets. So some between, 10 cents to 20, 30, yeah.
And you're in 34 African countries right now, I think. How long before you're in all of them?
So, it's been a 7-year journey, right, trying to build that infrastructure. Payment in Africa is highly fragmented, but Flutterwave is here, obviously, to solve that problem and plug that gap and make it simple and easy for the average guy to make payment. If you go to Kenya, for example, M-Pesa is amazing in Kenya, but there's no M-Pesa in Nigeria. So we, as Flutterwave, we build that gap where we connect M-Pesa in Kenya to the consumer in Nigeria or the money transfer family in London, right? The goal is obviously to build one-stop shop API that makes it easy for the average guy to pay and get paid in Africa.
You mentioned just now payments from the African diaspora back to the home continent. How big a part of the business is that for you?
It's growing massively, right? It's quite big. I think our retail revenue right now is 30% of our entire revenue built as a company, and that's huge, right? If you think about the fact that a year ago, we didn't have that revenue base, right? We built that from scratch. So it's quite big. Remittance is big for Africa, shared into Nigeria, into Kenya, and Egypt. So we're plugging that massively through our infrastructure and our scale.
Now, your last funding round, you were valued at more than $3 billion US. Is an IPO on the cards at some point?
Obviously, we're thinking how to raise capital for the company, and as we grow and scale, we'll think about the better to do that. But obviously, being IPO ready is good for us, so we're ensuring that we're building the world-class infrastructure, the best-in-class executive team to grow and scale the company. So that's on the table at some point, yes.
And were you to IPO, would London be in your sights, perhaps?
I'll keep you posted.
OK. What about competition right now? Obviously, the existing banks are there with a patch to defend. Are they more difficult to take on than some of the other fintechs?
So the way we see it, right, Africa is massive, as you know, right? There's no one who is looking at the problem from a regional perspective. There are folks who are like East Africa payment players, South Africa, North Africa, but nobody like Flutterwave is looking at the problem from one single view for Africa. So we are looking at that deliberately because we know the opportunity size and the value it creates. For our banking partners, we're complementing each other, right? We believe in banking and fintech partnership. We believe that fintechs can actually help banks to scale better and scale their business as well.
OK, GB, we have to leave it there. Good to see you this morning. Thank you.
you.
That's it for me. I'm back at 4:30 this afternoon with our afternoon edition. Hope very much to see you then. Thanks for watching this morning. Cheerio.